Example 16, financial statement presentation and disclosure for long-lived assets. The following exhibit include excerpt from the annual report for the year ended 31st December 2017 of Orange, an international telecommunication company based in France. Now over here we have this financial statement consisting of revenues, depreciation, and it continues. And over here we have consolidated net income of discontinued operations. And over here we have assets, equity, and this is excerpt from 2017 notes to the consolidated financial statement. This is regarding goodwill. And these are your perpetuity growth, post-tax discount rates, and this is your change. If there is a decrease in perpetuity growth rate, what will be the dollar amount change in these countries, or if there is an increase in discount rate, what will be the change in dollar terms. Now, table extracted presents only selected assumptions and selected countries. The company annual report provides more detail. Now, goodwill is not amortized. This is a very important concept. Instead, it is tested for impairment at least annually and more frequently when there is an indication that it may be impaired. These tests are performed at the level of each cash generating unit to determine whether an impairment loss should be recognized. Now, how do they recognize an impairment loss? That is, the carrying value of the asset and liabilities of the CGU or cash generating unit or groups of CGU is compared to recoverable amount. Now, what is your recoverable amount? For which Orange uses mostly the value in use. So recoverable amount over here is value in use, that is present value of future cash flows. Value in use is the present value of future expected cash flows. Cash flow projections are based on economic and regulatory assumptions, license renewal assumptions, and forecast trading and investment activity drawn by the group's management. Now over here we have book value for intangibles, and over here we have book value for property, plant and equipment. Now Orange Group operating income stood at 4,077 million euros in 2016 compared with 4,742 or 4,742 million euros in 2015. On a historical basis, a drop of 14% or 665 million euros. This drop on historical basis was largely attributable to the recognition in 2016 of 772 million euros in impairment loss of goodwill and 207 million euros of impairment loss of fixed assets, primarily relating to, now these are the impairment losses are coming from Poland, Egypt, Congo, Cameroon and Niger. And if you can see, Poland has the highest amount. Now our first question is, what proportion of Orange total assets as of December 31st, 2017 is represented by goodwill and other intangible assets? So for that we need to go to our financial statement, and over here we are given goodwill, other intangible assets and our total assets. So the proportion for goodwill would be 27095 million divided by 94714. That gives us approximately 0.28 or 28%. For other intangible assets, it would be 14339 divided by 94714. That is approximately equal to 15%. Now in the answer they have taken 97714. I think there is this slight mistake over here. Question 2. What is the largest component of company's impairment loss during the year ending 2016? Now, if you go back, we learned that the largest impairment loss was coming in Poland for 507 million euros. Now, this impairment loss mainly reflects a decline in competitiveness in the ADSL market, a deterioration in revenue assumption in the mobile market, and an increase in the post-tax discount rate due to the downgrading of the country's sovereign rating by the rating agency. Now over here we are given the Answer. So the largest component of 772 impairment loss on goodwill and 207 million impairment loss of fixed asset related to a 507 million loss in Poland. The company attributed the loss to the decline in competitiveness of the market for its ADSL technology, a reduction in revenue assumption, and increase in the discount rate resulting from downgrading of the country's debt rating. Question 3. The company discloses that it determines whether impairment loss should be recognized by comparing the carrying value of a unit assets and liabilities to the recoverable amount, for which the company uses mostly the value in use. How does the company determine value in use? As we have just discussed, value in use is your present value of future cash flows, expected cash flows. So the company determines value in use, which it uses as a unit assets and liabilities recoverable amount in impairing testing as a present value of the future expected cash flows. The cash flow projections are based on management assumption. By what amount would the estimated recoverable value of the company's operations in France, Spain, Poland, Belgium, and Romania change if the company decreased its estimate of perpetuity growth rate by 1%? So the growth rate is going down by 1%. So technically, the present value will go down. And by what amount would the estimated recoverable value of these operations change if the company's increase is estimated of the post-tax discount rate? So if the discount rate is increasing by 1%, this will again reduce our present value. So again, a reduction in growth rate would reduce our present value cash flows, and discount rate increase because discount rate is the denominator. If the denominator is increasing, it will again decrease our present value of cash flows. And by how much? And by how much we need to go to this table. So if there is a decrease in 1% perpetuity, so in France 10.4 plus 1.6, 0.6 plus 0.3, that is approximately 13.2 or exactly 13.2 billion. And this will go down because there is a decrease in growth rate. And if there is an increase in discount rate, so we will going to add 11.4 plus 2 plus 6 plus 0.3. This will give us 14.6 billion. And this is again a reduction. Why? Because the discount rate is increasing. So example 5, what are the largest components of other intangible assets as of December 31st, 2017? What is the largest component of property, plant and equipment as of December 31st, 2017? So for this, we need to go to this table. So for other intangible assets, the largest one is telecommunication license, then Orange brand and software. So these three consist of the largest amount. And for property, plant equipment, it is network terminals. So we can see it's 22,880 and the total amount is 26. So the largest one is network and terminals. As we discussed, the largest component of other intangible assets as of December 31st, 2017 are telecommunication license, software and Orange brand. And the largest component of property, plant and equipment is your network and terminals. Example 17, using fixed asset disclosure to compare companies' fixed asset turnover and average age of depreciable assets. So you are analyzing the property, plant and equipment of 3 international telecommunication companies. So the first one is again Orange, second one is BCE, and the third one is Verizon. So this is the information given to us, and all three uses straight line method. So based on the above data, for each company, estimate the total useful life, remaining useful life, and we also need to find out the age. Now let's do this for Orange. The total historical cost, the total value is 97092. So what is the total useful life? So if the total value is 97092 and the depreciation amount is 4708, so it is straight line. So each year we have depreciation of 4708. So what will be the total life? So total life would be 97092 divided by 4708, and that gives us 20.6. So estimated total useful life is 20.6. And what is the estimate age? What is the current age? So at this point, currently, the net accumulated depreciation So if let's suppose we are standing over here, so the cumulated depreciation is 70,427. So 7427 divided by 4708 will going to give us the age of this property, plant and equipment. So 70427 divided by 4708 gives us approximately 15. So this is the current age. This is the current age. And we also need to find out the estimated remaining life. So for estimated remaining life, we need to find out how much value is left. So at the end of the year, the total value is 26665. So 26665, 26,665 divided by 4,708. So again, this is the value, that is 26,665. This is the remaining value, and each year if it is depreciated by 4708, so the remaining life would be 5.66 or 5.7. So if you want to find out the total age for BCE, again the total value or the historical cost was 69,230. So the total life would be 69,230 divided by the depreciation, that is 3037, and again it is straight line, so the total life would be 22.8. The current age would be, so at this point the accumulated depreciation is 45,197. So 45,197 divided by 3037 is equal to 14.9, and the remaining life would be, so the remaining value of this asset is, so the net property, plant and equipment at end of the year is 24033. 24033 divided by 3037 will give us 7.9. So 22.8, 14.9 and 7.9 for BCE. Now we want to find out for Verizon. So again the total historical cost was 246,498, and each year the depreciation was 14,741. So the total age would be 246,498. Each year the depreciation is 14,741, and this gives us the total life as 16.72. So at this point the accumulated depreciation is 157930. 157930 divided by 14741, that is equal to 10.7. So this is what that has been consumed. So out of 16.72, 10.7, this is the age of this property, plant and equipment. So the remaining value is the net property, plant equipment at the end of the year, that is 88568. 88568 divided by 14741, this equals to 6. So this is the remaining life. 16.7, 10.7 and 6. 16.7, 10.7 and 6. Now second question is, interpret the estimates. What item might affect comparison across these companies? So if you look, now Verizon has taken the total useful life as 16.7, that is the lowest of the three. So it means that the estimate life for Orange and BCA is higher, so they are so the depreciation that they are calculating is low, so this will go into effect. Now let's see what the answer is. The estimated total useful life suggests that Orange and BCE depreciate PPE over a much longer period than Verizon. So 20.6, 22.8 for Orange and BCE, and respectively for 16.7 for Verizon. The estimate age of the equipment suggests that Verizon has the newest property, plant and equipment. So if you look at the age, so age is, Verizon age is 10.7, so it is the youngest, and for Orange and BCE they are almost 5 years older. So it might mean that if the property, plant and equipment are, if they are young, so they might be more productive. Anyhow, so the estimate age of the equipment suggests that Verizon has the newest property, plant and equipment with an estimate age of 10.7. Additionally, the estimate suggests that around 73% of the Orange asset useful life has been passed. So the total life for Orange is 20.6 and 15 has already passed. So almost 70% of the life of Orange has been passed. In comparison, only 65% for BCE and 64% for Verizon. And other things that can affect would be items that can affect comparison across the companies include business differences such as difference in composition of the company's operations and differences in acquisition and divestiture activity. This result can be compared to an extent to the useful lives and asset mix disclosed in the company's footnotes. However, differences in disclosure, example, the categories of assets disclosed can affect comparison. Now, in this example, the most important thing is that Verizon is taking estimated total life as it has a lower total life, so the depreciation expense over here might be high. It would be high, and it has relatively young property, plant, and equipment, so the total age is 10.7. How does each company 2017 depreciation expense compare to its capital expenditure for the year? Now, if you look at the annual depreciation and capital expenditure, each company is spending more on capital expenditure than on depreciation. So again, they are they are building up their assets as the depreciation is pulling the assets down. And for example, for Orange, 5677 divided by 4708 is 1.2. So it means that for every one depreciation, we are spending $1.2 in our assets. For BCE, this would be 4149 divided by 3037. This is again approximately 1.4. For Verizon, it is 17247 divided by 14741. That is approximately 1.2 as well, or 1.17. So each time we are spending more money on our property, plant, equipment as they are being depreciated. So all three companies' capital expenditure exceeds its depreciation expense. Rounding to the nearest 10%, capital expenditure as a percentage depreciation is 120% for Orange, 140% for BCE, and again 120% for Verizon. All three companies are replacing property, plant, and equipment at a faster rate than property, plant, and equipment is being depreciated. A very important point. And this is consistent with the company's somewhat older asset base. Lastly, we need to compare and calculate and compare fixed asset turnover for each company. So total asset turnover would be sales or revenue over average fixed asset. Actually, we want to find out fixed asset turnover. So sales divided by average fixed assets. So for Orange, this would be, so the revenue is 41096, whole divided by assets. So average assets would be the property, plant, equipment at the end of the year and the beginning of the year are given. So the average would be 26665 plus 25912 whole divided by 2, and this would give us 1.56. For BCE, this would be revenue is 22719 divided by average asset, that would be 24033 plus 22346 divided by 2, approximately 1. And for Verizon, this would be revenue would be 126034 and average asset would be 88568 plus 84751 whole divided by 2, and this would give us 1.45. Now out of the three, Orange has the best fixed asset turnover ratio because for each fixed asset it is producing the highest revenue. So fixed asset turnover is calculated as total revenue divided by average net property, plant, equipment. Orange fixed asset turnover is approximately 1.6. BCE fixed asset turnover is 1, Verizon fixed asset turnover is 1.5. Orange and Verizon higher level of fixed asset turnover indicate these companies compared to BCE are able to generate more sales per unit of investment in fixed assets, as we have just discussed. Example 18, financial statement presentation and disclosure for long-lived assets. The following exhibit presents information excerpt from the annual report for the year ended 31st December 2017 of Into Property, a property company headquartered in London that owns, develops, and manages shopping centers in the United Kingdom and Spain. Its common stock is listed in London and Johannesburg. Now, this company, it invests the money in shopping centers, and they also develop land. And over here in the balance sheet, we are given that the investment and development property. So this is one part. Another asset is your plant and equipment. So total assets is a combination of these two. Now, as we can see that the investment and development property are quite high because this is what the business is all about. So they are investing in shopping center, they are developing land and so on and so forth. Net rental income, so the shopping centers or whatever the property they have, the rental incomes are coming. And revaluation of investment and development property. So we have revaluation, either the value of these properties are going up or down. Now, excerpt from note 2 accounting policies, investment and development property. Now, investment and development property is owned or leased by a group and held for long-term rental income and capital appreciation. So these are the two rationale why they are investing. The group has elected to use the fair value model. So in fair value model, we report the assets under the fair value, whatever the fair value is, and if the fair value is higher than the cost, the gain would go directly to the income statement, and if the fair value is lower than the cost, then the loss will also go to the income statement. Now, properties are initially recognized at cost and subsequently revalued at the balance sheet date to fair value as determined by professionally qualified external valuers on the basis of market value, with the exception of certain development land where an assessment of fair value may be made internally. External valuations are received for significant development land once required planning permissions are obtained. The cost of investment and development property includes capitalized interest and other directly attributable outgoing incurred during development. Interest is capitalized on the basis of the average interest rate on the relevant debt outstanding. Interest ceases to be capitalized on the date of practical completion. Now, this is very important. Gain or losses arising from the change in value in the fair value of investment and development are recognized in income statement. Depreciation is not provided in respect of investment and development property. And third point, very important, gain or sales arising on the sale of investment and development property are recognized when the significant risk and rewards of the ownership have been transferred to the buyer, and the gain or loss recognized is the proceeds, so whatever the cash we are getting, less the carrying value of the property and cost directly associated with the sale. So the cash we are receiving, so these are our proceeds, minus what the carrying value of the property and the cost directly associated with the sale. So this is our gain or loss if we sell the property. Now, what is plant and equipment? So we have investment and development property. And what do we have under plant and equipment? So plant and equipment consist of vehicles, fixtures, fittings, and other equipment. Plant equipment is stated at cost less accumulated depreciation. So this is a difference. Over here, the method that we are using is that we use depreciation. So cost less depreciation, that is the value of the assets, and any accumulated impairment losses. Depreciation is charged to the income statement on straight line basis over an asset estimated useful life up to maximum of 5 years. Excerpt from note 14, investment development property. The market value of investment and development property at 31st December 2017 includes 8,831.9 million. in respect of investment property and 375.6 in respect of development property. All the group's significant investment in development property relates to prime shopping centers, which are of similar nature and share characteristics and risk. Valuation methodology. The fair value of the group investment and development property at 31st December was determined by independent external valuers. Fair value for investment properties are calculated using present value income approach. The key drivers of the property valuation in the terms of the lease in place at the valuation date. Now, again, so whatever the lease amount we are getting, the present value would give us the value of these properties. These determines the majority of the cash flow profile of the property for a number of years and therefore form the base of the valuation. Now the first question is, how do the assets included in the balance sheet line item investment and development property differ from the assets included in the balance sheet line item plant and equipment? Now, the assets included in the balance sheet line item investment and development properties are shopping centers, which the company holds for the long-term rental income and capital appreciation. So, as we know that this company owns, develops, and manages shopping centers, and the main rationale is rental income and capital appreciation. Where in 2017, the company reported net rental income of 423.4 million. The balance sheet line item of plant and equipment includes, as we have just mentioned, plant and equipment consists of vehicles, fixtures, fittings, and other equipment. So the balance sheet line item plant and equipment includes vehicle, fixture, fittings, and other equipment used by the company in its operations. How does the valuation model used by the company for its investment and development property differ from valuation model used for its plant and equipment? So for investment and development property, we use fair value, where initially the value of the property is reported as cost, and then it is reported as fair value, and whatever gain and loss it occurs, it is reported in income statement. So the valuation model used by the company for its investment and development property is fair value model, in which properties are initially recognized at cost and subsequently revalued and shown on the balance sheet at fair value. All changes in the fair value of the assets affect net income. That gain and losses, they go towards income statement. The company employs external valuation experts to determine the fair value, which is based on expected future cash flows from rental income. Secondly, we also need to find out the difference from the valuation model used for its plant and equipment. So for plant and equipment, we use cost minus accumulated depreciation and impairment losses. So the valuation model used for its plant and equipment is known as historical cost model, in which properties are first initially shown as cost, and then as time moves on, the cost is reduced by accumulated depreciation and any impairment losses. How does accounting for depreciation differ for investment and development property versus plant and equipment? You need to understand, in investment and development property, there is no depreciation expense. So depreciation in accounting refers to the allocation of the cost of a long-lived asset over its useful life. Now, no depreciation is recorded for investment and development property because it follows fair value model, and depreciation expense for plant and equipment is calculated on a straight line basis over the asset's estimated useful life, as it was stated in the footnotes. Now, the revaluation gains and losses on investment and development properties indicate the properties have been sold. Now, if fair value has gone up, there is a gain. If it has gone down, it is a loss. Certainly, it doesn't mean that we have sold the property. No. The revaluation gains and losses on investment properties arise from changes in the fair value of properties that are owned by the company. The company reported a revaluation gain of 30.8 in 2017 and revaluation loss of 78 in 2016. The sales, as we discussed before, is equal to proceeds that we get minus the carrying value of property. Now, this carrying value of property is actually, we also need to deduct depreciation and any related cost. So, sales of property would have resulted in a gain or loss on disposal, calculated as a proceeds minus carrying value of property and related selling cost. And this can also be seen over here. The gain or loss recognized as the proceed received less the carrying value of property, whatever the carrying value of the property is, and cost directly associated with the sales. Now, carrying value would change as time moves on because there would be depreciation that would occur.